When you start learning technical analysis, the sheer volume of candlestick patterns feels paralyzing. You are often handed a cheat sheet with dozens of shapes, hammers, stars, and soldiers, piling up in your mind, creating total sensory overload. But drilling flashcards to recognize geometric shapes does not make you profitable. A candlestick only matters based on the structural context of where it appears on a chart. Every time a bullish signal flashes, you face a core choice. Do you trust this candle to reverse a market crash, or do you wait for a signal that proves a trend is safely continuing? Your answer depends on which of the two main families of price action you rely on, reversal patterns or continuation patterns. To choose, you weigh mathematical trade-offs on this quadrant chart. Reversals land top left. Catching a bottom offers high reward, but fighting momentum means low probability of success. Continuations sit bottom right. Absolute profit is smaller, but your win rate increases by joining established flow. Understanding this mathematical give and take allows you to stop guessing. It helps you deploy the right tool for the specific market environment in front of you. This comparison matrix breaks down the mechanics, starting with reversal patterns like engulfing candles, hammers, and stars. Their function is catching the absolute beginning of a new phase. Trading a single candle reversal means moving countertrend, betting that immediate, heavy momentum has exhausted itself. This massive trade-off of fighting existing momentum usually results in mistaking a brief pause for a true reversal, quickly hitting your stop loss. To mitigate this, traders use multi-candle setups like morning stars, requiring structural confirmation before entering. But waiting for confirmation creates a secondary trade-off. Filtering false bottoms sacrifices the optimal entry price, reducing the risk-to-reward ratio. Reversals are volatile tools, best reserved for predicting major pivots at key levels, where there is very little room for error. Shifting focus to continuation patterns, like flags and the three methods, the goal changes. Here, the function is aligning capital with established institutional flow. Instead of fighting the move, you enter after a period of price consolidation following a strong initial breakout. The primary benefit here is a higher win rate, joining a momentum wave already proven by the market. The trade-off is the patience required to wait. You must avoid chasing the initial pump and accept missing moves that never offer clear consolidation. There are more aggressive setups in this family, such as runaway gaps and momentum candles, which capitalize on maximum market participation. These aggressive entries carry a risk trade-off. Entering late after a massive move means your required stop-loss distance must expand below that volatility. To manage this, you use smaller position sizes, scaling down the capital to keep total account risk the same. Continuations demand patience and often yield smaller absolute profit margins. However, they provide the statistical advantage of moving in the same direction as the established trend. Then there are doji and spinning top candles. Look at the narrow, symmetrical bodies. They represent a complete lack of conviction from both buyers and sellers, pure market indecision. A common beginner trap is attempting to trade these candles in isolation when they appear in the middle of a chart. The consequence is that your capital gets tied up in a dead zone. You are likely to get chopped out as the market moves sideways without clear direction. On their own, dojis are just shapes. They only become valid signals for reversals or continuations when they form exactly at major structural levels. To navigate the candlestick dilemma effectively, you must match your psychological profile to the pattern family that fits your specific goals. This decision tree simplifies the process. The first filter for any trade is establishing the exact market context before you even look at a candlestick shape. If you have a high risk tolerance and want to catch the exact start of a move, you follow the path of the reversal hunter. Your mandate is that setups are only viable at extreme historical areas of support or resistance. If you prefer a higher probability of success and lower stress, you take the path of the trend follower. Your mandate is to ignore the urge to catch tops and bottoms, exclusively hunting continuation patterns in the middle of established trends. By following this framework, trend followers experience less stress and build compounding equity by riding the momentum that is already in place. Reversals exist to predict pivots. Continuations exist to confirm flow. Consistency in trading does not come from memorizing a dictionary of shapes. It comes from identifying who is in control of the trend and selecting this single category of signal that fits your risk appetite.